I think what I'm seeing in the global north is deep tech. So deep tech that requires very, large capital outlays, maybe longer investment periods.
There's this book I've been reading about Africa's billionaires.
Yeah.
Basically, entrepreneurs who've scaled ventures across sectors, and some of them are actually almost now doing philanthropy in addition to their commercial work, and some also doing in addition to just the ventures they're running, they're also running family offices and funds.
What I'm seeing in the African space is the stacking. You say pay as you go has had its own it's had its own ups and downs, but I think looking at the income inconsistencies of in like the people in the informal sector, a lot of the shocks that come with inflation and food, people keep, I think in economics it's called the substitution effect.
Hi there, welcome to the Startup Evangelist. Daniel Kitwa here. I'm joined by Valentine Tenge, an investment professional in the climate and tech space. Good to have you, Valentine.
Thank you. Happy to be here.
Yeah, maybe to start us off, I know you've worn so many hats. You're the founder of Nairobi Brew. You're part of a global climate investment network. But just for the sake of the audience, who are you? A bit of your background and what you're up to with all these work you're doing.
Okay. So I started out in the asset management industry, working as a research analyst at Nabo Capital. And then later on during the pandemic, transitioned into full-time investment work in climate. So I was part of a fund that was doing concessional capital for distressed companies that had been distressed by the pandemic. And then over time, I realized the need to have a professional hat, but then to have my own personal brand, which is why I started the Nairobi Green Brew. And it was more or less an attempt to have long-term relationships with founders. So beyond the no stage, beyond the I can't invest in you stage, you do want to maintain like solid relationships with founders and other ecosystem builders. And so I started that. I've managed to host a few fundraising cafes, which are sort of informal meetings where there's no pressure to pitch, there's no pressure to, say this is what I'm raising, or soliciting funds from other people in the room, and sort of just creating a comfortable atmosphere for people to network and learn and know about each other. Outside of that, I'm also an ambassador for Investors for Climate, which is a global community of different investors across the world interested in investing either in the global north. I think in Africa, there's only 2 or 3 of us who are ambassadors, and our work is pretty much to raise awareness on climate investments, ecosystem events happening around to link people up, and also deal flow. So serving as a local due diligence partner on, verifiable deals on ground.
Wow, interesting. That's a very rich background. Maybe a bit on the asset management side. It's very, I would say standardized. There are clear underlying assets, if it's mutual funds, if it's government bonds. Maybe the transition from that to now, looking at distressed portfolios. What is the approach to analyzing such businesses or such SMEs or ventures, noting that, we are living also in an environment, a tough economic environment, and a lot of SMEs and startups are probably in that sort of, for lack of a better word, graveyard stage.
I think the asset management side is one full of compliance requirements. There's strong governance and all that. But I think for me, the shift was in finally now trying to understand the business from a perspective where I'd put my money in. A lot of the work in asset management, I think it's focused on client stewardship. So you need to act in a way that ensures that client money is safeguarded and there's capital preservation. But on this other side, there's a lot of seeing a business before it actually comes to fruition. So it requires a lot of, like, more or less like a wide understanding of how different measures of the economy work. A lot of the work in, the asset management side is driven by macros, regulations. There's a lot of reporting, and then there's also a lot of, besides compliance and governance, I think there's a lot of rigidity and regulatory oversight. But on this other side, there's a lot of, let me say, spray and pray, where you need to spread your risk wide enough for you to have a few winners. Yeah, so I'd say that was the main difference, trying to, have an inside out perspective of a business, as opposed to, in the asset management world, there's a lot of comparables. There's Safaricom, you can compare to another entity in South Africa and whatnot. But what I've noticed on this other side of things could be you're working on a solution or a deal that's very specific to the Kenyan ecosystem, Kenyan landscape. So you sort of need to have that local knowledge.
Interesting.
Yeah.
So I guess, asset management, very, very standard, compliance, governance, lots of data to compare.
Yeah.
Unlike now, the other alternatives, even though, the regulations allow for, the large asset managers to actually deploy capital to climate. I think we'll talk about that. But maybe on the distressed side, were you trying to buy like a loan book that has gone bad? Were you trying to what specific? How are you approaching the investments? And maybe you could paint a picture on the sectors you're looking at. What stage of business and growth or scale were you looking at?
So distressed in the sense that a lot of, I think due to the supply chain shocks that came with the pandemic, a large number of solar oriented companies in Kenya had to either deal with excess inventory, lack of inventory, inability maybe to reach their last mile customers and whatnot. So at the end of the day, that sort of has an effect on their bottom line, which is their profit. But then, given that was something that was fully understood in the industry, it sort of didn't mean that, these companies had come, their business model was, in the waters, and it was doomed for them. So this was distressed in the sense that the company's projections or repayment capabilities in the near future was going to be affected.
Constrained.
But that wasn't a reason for you as an investor not to invest in. So more or less like timing the market and getting it at a time when you can provide support for operational expense, working capital, and then hopefully post-pandemic have everything come back to normalcy and a proper repayment of,
Yeah, and were these all in the PayGo solar, or there were other, solar adjacent or clean energy adjacent sectors, as it were?
So it was the full stack. We had solar home systems, using the pay-as-you-go model. We had off-grid projects in the very remote areas in Kenya. We had, I think, commercial C&I, commercial and industrial, deals that we did that required. So the minimum ticket size was around 250,000 USD to as large as 2.5 million. But then pretty much everything was tied to clean cooking and solar products.
So I guess across the stack of appliance and energy access and even C&I.
Yeah.
Interesting. Maybe a question on the same. We have a lot of, I would say, I think the data out there is like 80 to 90% of, climate or funding to renewables or other similar spaces in Africa coming from the global north. And we've seen how that quote unquote marriage or dependency has had an issue and impact on, local companies raising funding. And for the largest, I think for the larger companies and the legacy companies, they raised a lot of, almost, VC money or capital that was not optimized for their business model. are you seeing that change, in terms of the archetype of capital we are raising? And if so, where should founders look for, and what opportunities or instruments are you seeing?
So I think, especially with the withdrawal of foreign aid, I think what I'm currently seeing on ground is a renewed, interest and like sort of forward thinking by philanthropies who have, I think, been the largest players in the grant space. So, and if you look at innovative financing models, let's say like a blended finance model that, you either have fast loss capital or more or less, the kind of capital that would cushion the most sensitive investors. We're seeing potential for, philanthropic capital coming in at that level, and African philanthropic capital, not foreign philanthropic capital. So we do have a few players in the industry who are coming in to merge that gap. From a founder's perspective, I think understanding where you are in the business cycle is very important, which then would mean, do you need grants? And I know grants have had their own reputation, but if you are someone who's tried to apply for a grant in this industry, it's a lot of brain work, it's time consuming. You might as well be looking for the right form of capital, looking for a grant. So at a founder level, we know climate tech industry in Kenya, it's, equity financing would be most ideal, but it's still very rare and almost unaffordable, if I can say that. For debt instruments, I think we still don't have, like large, growth companies that would be able to repay that within the required time and even grow at, as you're repaying the debt. So from a founder side, you need to understand where you are in the life cycle, what capital is, appropriate at your stage. Also have a clear, investor mapping of which investor you need to be approaching. So you could, if you're not aware, you could, easily be having a lot of, cold emails, reaching out to investors who are, don't provide grants, but you're, maybe busy sending out pitch decks and chasing the wrong investors.
Interesting. You've mentioned African philanthropy. There's this book I've been reading about Africa's billionaires. Basically, entrepreneurs who've scaled ventures across sectors, and some of them are actually almost now doing philanthropy in addition to their commercial work, and some also doing in addition to just the ventures they're running, they're also running family offices and funds. So I think there's an interesting trend in terms of African capital now looking for a home outside now the government bonds and treasuries. So now, like, if it's family offices, if it's local impact investments or local philanthropies, as it were. So I think there's a very interesting trend happening. I think it will just take a while for that to catch up and maybe make a dent to to the global financial flows that are kind of skewing our metrics. Maybe a question on your work now with investors for climate. You've mentioned that a lot of the deals you've seen are in the global north. Are they all tech-enabled climate, or what types of asset classes are you seeing? Are they very different from the opportunities that we are looking at in terms of Africa? So that we see, is it an apples to apples, or it's a very different market?
So I think what I'm seeing in the global north is deep tech. So deep tech that requires very, large capital outlays, maybe longer investment periods. What you see in Africa, on the other hand, is, I think, climate resilience. So climate resilience is more, it tries to link the, investors with the informal sector. So I think you're seeing a rise in insurtech, which is products being bundled up I'm sure you'll see every other founder now says, we provide inputs, but we've partnered with so-and-so to, have a micro insurance product on top of that. And these ideally are adaptation, are sort of inclined towards the adaptation sector, which is not like mitigation. Mitigation, I think, is commercial and industrial, which are large scale and can take large amounts of capital. But adaptation is the small, maybe irrigation proofing your food systems. Like I said, micro insurance. I can't think of pay as you go.
And maybe it's a good question whether pay-go is mitigation or adaptation. But also I think there is the aspect that in our side of the world, you are not going to scale a product if your product just is the equipment, and you've not thought about the end user financing because of the whole affordability problem, right? So if you're giving agri inputs to farmers, smallholder farmers, owning 2 to 5 acres. What does that mean in terms of their pay plans? What does it mean in terms of the cost of capital for them as well, right?
Yeah. So a large part, what I'm seeing in the African space is the stacking. You say pay as you go has had its own, it's had its own ups and downs. But I think looking at the income inconsistencies of in like the people in the informal sector, a lot of the shocks that come with inflation and food, people I think in economics it's called the substitution effect. So as much as you'll find a lot of the repairs saying, instead of me prioritizing this repayment for this immobility, appliance, I'll focus on food. So I think I'm seeing another model, revenue-based financing, which is aligned to the amount of revenues you're bringing in as a company. So if you can stick to maybe, let's say 5 to 10% of your revenues until you break even, that's on the investor terms to the investee, to the founder and whatnot. I've seen that model coming up even at the fund level. I think we now have funds that are just revenue-based financing model. So hopefully that could be, because the problem with pay as you go is the fixed amount. You ask what happens on a day when this founder or this electric motorcycle owner doesn't make the 500 shillings, what happens to them?
It's because we're also careful not to create a debt bubble, right? Because we are not our economies are not geared that way. Like if you look at the US during the real estate bubble, the famous mortgage in 2008, there was the option of government buying these distressed assets, right? These loans, and taking them off the banks and whoever. But here, if the whole system crumbles, God forbid, you're left with idle assets, you're left with stranded equipment. I've gone to projects, I see very huge dryers and irrigation systems that someone installed, they couldn't manage O&M, and the community is left hanging dry, and maybe they've even paid off for the product, right? So it's a very interesting approach. So you've said in the global north, deep tech. What else are there? What else are you seeing?
I think because they are capital markets, maybe I'll speak to what I'm seeing in the capital markets. I think if we're speaking about the climate space, their capital markets are sort of more, because if you look at it again, the capital market players are like the largest emitters.
Like the Teslas. No, like the other tech.
Just general, let's say a manufacturing company, like maybe Nike.
Yes.
So the more you produce, the more, of course, the industrial processes, so from that side of things, I see a lot of the capital markets players, being a bit responsible, coming forward with things like reporting. There are green taxonomies, which are meant to classify what activities are green and what are not green. And that in a way is as much as the political environment is sort of anti-climate, I think they're very forward-thinking in one, intentionally trying to reduce emissions. I think in Africa, we're still gambling with whether we should move forward with infrastructure and development and, subsequently increase emissions, or hop onto the climate story and leapfrog, as they call it.
Yeah, interesting. Yeah, I think also here, our pitch is always like, even if the story is good for the environment, it has to be affordable.
Yeah.
So like a lot of I've spoken to a lot of solar companies, for example, and especially those targeting rooftop residential or even commercial industries. The biggest issue is what is your cost base vis-a-vis the national utility, Kenya Power or TANESCO or whoever, in terms of what that means to my bottom line. So I think there's that, because there's largely no other external incentive. There's no tax rebate like what the Teslas got in California and other places, compared to for our case, right? So there's that sort of mismatch.
For me, I'm seeing it as, again, I think the capital markets in Kenya have been very dormant. I don't think we have more than 4 or 5 on the corporate bond category. We maybe 4 or 5 active, tickers. So what you're thinking of within the capital markets is, being forward thinking, let's say approaching the owners of this building, taking the incentive to do a model that shows this is how your outlook looks like if you continue using, KPLC generated, energy. And these are the cost savings you get by maybe doing an installation and whatnot. So if you're able to do that in a way that then ensures, one, the proceeds of the corporate bond are ring-fenced to just the upgrade to clean energy or renewable energy financing, then there could be hope. But then again, we're still trying.
Yeah, because structured finance, ring fencing the revenues and all. Maybe a question on next. Let's think future now. Like next 5-10 years, where do we go from here? Maybe let's go back home now, Africa.
Yeah. Where do we go home from here? So currently, as it stands, we desperately need to think inward. I think everyone is a bit optimistic about what has happened, and people are now like, this is a very good time. Sometimes looking at it from a lemonade perspective, like it's an opportunity for us to start thinking. If we've had issues with delivery of the grant programs or grant projects, then it requires us as a country entirely to think about accountability, and not accountability in the sense of the regulator says this and that, but if you're a fund or a fund manager, or even I think mostly sometimes the issue comes from the NGO side, where the pressure either to take back money to investors is not as hard as fund manager. So the project can take as long as as much time as you have. Yeah. So from that perspective, I think looking inward, that would mean local capital. So local capital, like we said, trying to invite pension fund managers, because that's where a large part of local capital is.
We have like more than what, 20 or something, a very big trillion shilling number. That is almost just sitting outside the game, and it's not investing into some of these alternatives.
So again, to piggyback on that, if we can have like funds partnerships where, as much as let's say a pension fund manager like Old Mutual, maybe they do have a cap of 5% from RBA on how much they can direct to alternatives. It's time,
and that's 5% of a huge
huge of a number. So if we can have partnerships maybe at the fund level, where then the money comes in at maybe at the senior debt level to sort of mirror the risk or the risk averseness that's required with pension investments. That's one way I think we can tap into local funds and then have, again, similar African philanthropic capital coming in at the maybe first loss, or like an anchor investor who ensures, the most sensitive investors don't lose their money. I think I see that as the way forward, because the tap is dry now and it's time for us to think within.
Maybe a challenge to you guys. I have so many friends like you who've you went exited the asset management side, I guess, out of those challenges in terms of doing something new and all. Maybe I think it would mean some of you have to go back, serve in those investment committees, in those boards, lead those organizations. Because I think at some point they will actually need to be, almost a changing of guard, a transition. Because I think some of these have to do with culture and outlook. We have a huge ecosystem of fintech, crypto, very interesting assets. It always comes with certain risk tolerance that needs to be factored in, and even now on climate, I think it will also mean the onus would be for people who've either been in those spaces before, either going back and creating those partnerships.
And I think that has been my experience these past few months. And you sort of notice that when you're coming from this venture side, private equity side, it's something that people believe in it at a very individual level. So outside of your formal job, it's something.
It's a core. It's a belief system.
It's a belief system, and you'll find someone in their house with either a product, whether it's a delight, a delight kit or something. But I think there's a lot of mentality, and I think that comes with ecosystem. I've noticed the ecosystem side of things in the asset management side is tied to earnings calls, very structured, not as tight-knit as the private equity venture capital side, where you're always either in a workshop, either in a conference. And I think that helps to change mindsets, because
and
you're constantly
and
to co-create. Exactly, because you sort of think of why is it that your team is not able to come and you get real-time feedback outside of the back and forth that comes with emails.
My question on tied to future, I know there's a challenge right now, particularly on exits, either on equity. I know for debt it's a bit interesting because it's self-liquidating. When you are doing the distressed investments, how are exits for you? How are you approaching? Is it based on how you model the payment period? How are you engaging the founders, and what were the options on the table that you're looking at?
So 99% of them were either convertible debt or self-liquidating instruments. So in that case, it means if I think the founder of the company has issues repaying, you have to restructure. So either increase the repayment period, or reduce the repayment amount. In terms of convertible debt, you have the option to either convert into equity, or there is now the secondary sale where you
find a buyer.
You find a buyer who comes in. But I'm also seeing a new model that I hope can be, it's still in its teething stages, which is corporate venture capital, where we have a lot of startup ideas, I think, in the African continent now. And if you're like me, you've been in this industry, sometimes it can be a bit overwhelming. You're maybe speaking to 3 founders who are doing the same thing and are not willing. Everyone wants to maintain ownership or independence of their brand and whatnot. So how corporate venture capital works is you approach, currently I'm saying a model that's active is you approach maybe Britam. You focus on not really the systemic problems within Britam, which would require automation, but a problem that more or less like a plug and play solution that would not only serve Britam, but Sanlam and all the other insurance players.
So you turn their database into a client kind of model. You partner with
problem
them.
statement. So you turn their problems into like a startup solution, hire a founder and the entire team, train them on governance, build the company to a point where you can either attract either other LPs into the deal, or have like a spin-in. A spin-in would be now Britam, spinning in the company into its own. And I think in the near term, for those who are building, that can be a good way to, instead of always looking for original ideas,
and then you run into the issue of the term, total addressable market. Like if it's too original, then is there really a market, right? So if it's a very, niche thing that will only serve Kilimani or Westlands, how big can you grow the pie? And because if you keep raising, you'll be, I guess, you'll be diluted, and you still get back to the issue of you lose control at some point. Since you're not able to grow the market, to a certain scale to sustain your capital raise.
And the best thing about that as well is Britam, the corporate itself, gives you, if Britam was just to tap into 5% or 10% of his customer base, you can imagine how much that would cost a founder in terms of acquiring that customer. So it's like giving you a tip of, our customer base for you to validate your product or solution. And then once that, if you've managed to prove that with just a subset of, their client base.
Yeah, interesting. So almost like have, like an internal partnership where there's like sandboxes and stuff like that. A question on, looking at, this issue of future or scaling or what next. You've started now with Nairobi Green Brew. You almost, when you introduce yourself, you're mentioning the story of, you got tired telling founders no. And now you're sort of like, come, let's talk. Maybe explain how now the community aspect, you're tying, building community and long-term relationships with founders. How is it affecting their fundraising? Is it making it easier? How do you, are you more educating more investors about the specific nuances of their businesses? How are you using that to sort of almost navigate a different way of raising capital through either communities and stories, rather than just the standard way we've been used to doing things?
Okay. So I think for me, the first issue would be sometimes you get tired of pitches. Like at the end of the day, I've noticed even from the advanced economies, people who consistently raise have very strong networks. So sometimes the pitching sort of formalizes, or
it's the icing of a larger cake.
And it's very, how would I call it? You just get to see the surface of a person. So I'll speak about Nairobi Green Brew. The aim was to move away. My day job, I think I look at 10 to not less than 10 pitch decks. You always have someone sending you a pitch deck. Some are well done, some are just an idea that you take and put in a folder, or you now think, how do I respond?
You should say put on trash. I get it. I get it.
So one way was to, outside of my desk and meeting and conferences, get to know these people, because sometimes I'd meet people in conferences and they were like, maybe I don't really remember the details of their company, and they're like, but I've sent you my pitch deck. So I noticed it's way easier when I meet someone and then get to see their pitch deck later, as opposed to the other way around. So you meet someone, you know their rapport. Within that setting, it could be I'm with you, and it can serve like as a mini due diligence on this person is a reliable, founder, he has a good reputation and whatnot. So the aim was to sort of get people out of the rigidity that comes with pitching in conferences, speaking about numbers, and just getting to know, okay, outside of this, who are you? What do you do? What else have you done before? So trying to get the informal stories. at the Investors for Climate space. So what Investors for Climate prefers is you have 80% investors in any meeting and 20% founders. So have more money chasing, as opposed to having more. I think the standard usually is
the other way around.
You always have more founders in any
demand more than supply.
Yeah, demand more than supply. So trying to and I think with things like ChatGPT now, everyone has a good pitch deck. Everyone has good documentation. So you now want to see the conversational aspect of, someone and what's their business sense, who are they, as a business person, what's their personality. And also just trying to, the last time I did a fundraising cafe, I did something called fundraising seasonality. And it was the second time I was doing it. And the aim was we have all this traction, proper pitch deck, what's your ask, what's your term.
The usual.
They know those terms. But in terms of even just trying to understand, maybe it's November, it's Thanksgiving in the US. So because I've had founders previously, maybe on 2nd or 3rd January, someone asking me, where are you with the deal? So as much as it, you're maybe hell-bent on building your company, there's that unspoken, business etiquette or fundraising etiquette, if I can call it, knowing when to reach out to investors.
When to solicit, how to do it, and when, and also culture, because I think I think a lot of local entrepreneurs, and I've spoken, I have friends, I have people I know that they don't get it's a very different cultural ask when you're raising from someone in Europe vis-a-vis Asia or US, right? It's very, you can almost see, and even in Europe, it's very different how you speak to a funder in UK and compared to maybe Spain or Germany or wherever. So I think there's that, I guess, need to understand the soft aspects of because at the end you're dealing with a human being, as much as it's a fund or a VC or an angel, there's a human being behind that entire process. Right? Maybe a question on, I think you've mentioned, you've struck a chord. I've also seen that in this platform, like a lot of, a couple of founders have used their stories actually to raise. So I'm seeing a very interesting trend of like, people are very willing to slow down and get to know the person before looking at every other thing. And so we are going to a very interesting season of almost like founder-led, like the founder is a brand, founder-led brands, right? In we've seen how LinkedIn has transformed and other platforms, and I think that's where maybe Kenya is probably catching up to that sort of more than maybe some other countries, but I think it's definitely happening.
I think Kenya is, if I was to compare, I think Kenya is one of the very, forward-looking countries. If you are to, maybe Nigeria and South Africa come ahead of us, but if you are to look at it from a personality perspective, I think Kenyan founders the ecosystem is full of people who are very aggressive.
Yeah. And also they've learned now to do more with less, right? If there's less VC money, so you have to be very creative in how you approach break even, how you structure your business, your team to actually be resilient.
They've also, I think the Kenyan founders are one among the highly, most supported, ecosystem in Africa. We have, more than maybe even 50 incubators and accelerators right now. I think Kenya is one of the countries that has the largest number of DFI offices, locations, headquarters.
Someone was saying it could be a good thing and a bad thing.
Why?
So I think the good thing is like from an access point of view, it's there. The bad thing is if you don't get, the frustration is even because the expectations are high. So like, for example, I've seen how, Kenyan founders approach rejection versus other countries. Like, it's a very, and you've seen the debates on social media. So it's a very, I think when I think success in hindsight, it always looks good.
Yeah.
So I think there's that, but also the other issue is also we've over-engineered return expectations.
Yeah.
So like every DFI wants to be senior secured. Everyone wants to almost like be protected, take bells, whistles, collateral, everything.
Yeah.
So I think that's a problem you get with a stable market. But when you get to, I've seen deals in markets like DRC, like the paperwork is very different, because you're there you're told, are you in or out? Like this is how the situation is.
Don't tell me to open a data room.
Yes, like if fine, do you want to pick collateral in the middle of DRC, and what will that help you with in terms of securing land, right? So what other forms of comfort can you unlock? Is there something around the contracts, around the founders, whether it's a skin in the game and other things that you could ring fence your revenues around and get comfort in doing the deal? So I think also there's also some criticism that when you're in a stable market, like people want to almost bring a playbook that
doesn't work.
Yeah, so you're trying to make Kenya like the New York of Africa.
Yeah.
And we are growing, it's a hub and all, but we are not.
We need to be reflective of I think one of the projects you're sort of trying to work on is tokenizing impact. So I think even outside of the impact investing or climate work, I think right now reporting on impact has been, like it's even been sort of like discouraging for some founders because you're asking for so much. So I think what I'm seeing in the Eastern world is, and I think on the Hong Kong stock exchange is, how can you find ways to package all these small fractional receivables from the low income, informal sector in Kenya, and then package it in a way that can be traded on the Hong Kong Stock Exchange. And on that side, again, it's fractional. I think using blockchain technology, but in a way that also allows the, let's say, not so high net worth, when you say not high net worth in Hong Kong,
it's
that
relative.
Could be a millionaire in Kenya. So if you can tap both ways and find Hong Kong investors who would want to invest maybe 1,000, 2,000 USD into a fund, and then have that fund, it's more or less like a receivables fund, but traded on the stock exchange. And it's something that I think has worked in Hong Kong.
So you're looking at ways to do a deal here and see if it can
it can be packaged. So going into the small receivables and using, I think, IoT, because that's already what's happening with the when people are like Coco Networks and all these clean cooking,
it's
people say that they can
the
monitor
capital markets. So you can just almost transfer that into a more liquid exchange.
So if a company you've seen the impact metrics over the past 3 years and you're able to project that and package the receivables in such a way that this person is sure of, getting their 1,000 bob every day for the next 5 years. Why still stick to, I need a piece of land or I need, hard collateral for me to finance you? So it's something that might probably have to go through the sandbox. But to me, it's like we can't keep insisting on, developed world models.
Very, very interesting, Valentine. This was very insightful. I think there's a lot to chew on. You've mentioned, the work you've done in, financing distressed climate assets. You've mentioned also opportunities for capital markets and the alternatives to sort of join hands. The issues of storytelling, fundraising, and bringing almost a healthy balance in how we tell our stories as founders, and also the opportunities in the future, and how that compares currently with the West. So thanks. We'll put all your contacts and if events and stuff you're working on for people to engage and reach out. So pleasure having this. It's been long overdue.
Pleasure as well. I'm happy to be here and to share what I'm doing. And yeah, I think I've watched all the other people who've come before me, and I can say you are doing a good job just trying to get the non-obvious information to the people that really matter. So happy to be here and happy to share.
We are in the age of ideas, so information is power. So thank you so much, and for the rest, keep subscribing, sharing, and let us know what you think about this conversation. Cheers.
Thank you.